1970, the world changed. Fannie actually became Ginnie Mae. And a new company was created that was called Fannie Mae that didn't do what Fannie Mae used to do. Now, if that isn't confusing, nothing is confusing. And the new Fannie Mae became a publicly traded company, and it could purchase riskier conventional mortgages. And it had an implicit guarantee from the U.S. government, but not explicit, implicit. And in 1970, at the same time, Freddie was created to package those mortgages into bonds. And those bonds are called mortgage-backed securities, or MBSs. And to sell them to investors. Freddie became a public company in 1989. Fannie's charter, original charter in 1970, allows it to buy up to 100% mortgages as long as the amount over 80% is insured. Now, I've read several articles that say Fannie can't buy mortgages for over 80%. That's incorrect, and has always been incorrect. So the type of mortgages Fannie could invest in became wider and wider and wider over time. 78, 81, 83, Fannie was allowed to purchase multifamily housing mortgages, not just single. It was allowed to purchase second mortgages after the first, and second mortgages are riskier, of course. And then it was in 81, it was allowed to purchase adjustable rate mortgages. I have also read articles saying Fannie Mae could not purchase adjustable rate mortgages. That's untrue too. Now the caps, even the worse, not only did the type of mortgages Fannie could buy become more numerous and riskier, but over time the amount was raised and raised and raised and raised, which also increased the risk. And here the changes in caps. In the mainland USA, caps for Hawaii and Alaska are different. They're much larger. So 80, it was 108,000. By 2000, it became 252. By 2006, it was 417, and I think that's even before 2006. And 2008, temporarily was raised to 730. And the total amount of mortgages Fannie and Freddie were backing was $2.5 trillion in mid-2001, and by mid-2007, only 6 years later, it was $5 trillion. Now, in the same time period, the price of U.S. houses doubled as the Fannie loans doubled. And what they did, they had created a bubble feedback mechanism. The price of houses went up, they raised the amount of money they'd loan. The prices went up more, they raised the amount they'd loan more. The prices went up, they kept raising the amount more. This fed the bubble. The United States government was instrumental in creating the housing bubble by its housing policies. At the same time, Fannie and Freddie are supposed to help ensure that low-income people have access to housing. While on one hand, on the other hand, they're doing everything possible to raise the price of housing. So these are totally contradictory goals that make no sense. And these are quasi-governmental companies. They have backing by the U.S. government. They get special loan guarantees from the U.S. government. They get lower interest rates. So this gives them a big boost to any competitors. And whenever you have some company in the field that actually can raise capital or do things cheaply, more cheaply than anybody else, that company is going to eventually take over that field. The second half of last year, 90% of mortgages were backed by Fannie and Freddie. And the first half of this year, it's 81%. So effectively, the mortgage market has been nationalized. Not officially, not the jury, there was no law saying we're nationalizing the mortgage market. But in reality, it has been, because there's only this one quasi-governmental institution that's backing it. Probably few institutions in the United States that are more corrupt than Fannie and Freddie, and it is frightening what went on, and it's probably still going on. Both had major accounting scandals in the early 2000s. They were forced to take massive losses and pay hefty fines, and Fannie alone had to pay $1 billion just for the audit. $1 billion just for the audit. They purposely altered earnings to raise executive pay. The executives got bonuses, certain bonuses if certain earnings were made, so they just altered all the records to make sure those earnings were made. And during the audits, investigations, there was more than one investigation, They showed that Fannie and Freddie both overvalued assets, underreported losses, falsified signatures on accounting records, falsified, created fraud, changed the earnings records in the databases, they misclassified securities, and they misused tax credits. And they also determined they didn't use generally accepted accounting principles. Now, none of these executives went to jail. As far as I know, nobody went to jail. As far as I know, they didn't have to give any of the money back either. Freddie and Fannie are basically a dumping ground for political hacks and Wall Street cronies. And, you know, lots of ex-congressmen get very lucrative consulting contracts with Fannie and Freddie. Lots of people from Wall Street, which makes a fortune on selling Fannie and Freddie loans, wind up working for Fannie and Freddie also. And if you look at their accounting records, you'll see they have extremely high expenditures for lobbying activities. This is what they did with their lobbying expenditures. 2003, we'll start with OFEO is the organization that watches Fannie and Freddie as the regulator. The head of the OFEO in 2003 issued a report that had been 2 years, a study that had been done for 2 years. And he warned that financial calamities could happen because of excess leverage in Fannie and Freddie. He was promptly fired by the Bush administration. Then, around the same time, Representative Cliff Stearns, whose committee Fannie and Freddie was under his committee, he had an investigative hearing, and he announced, well, we're going to have more. His jurisdiction was promptly removed from his committee by the Speaker of the House, who was Hassard at that time. It was given to Mike Oxley, who didn't want to have any hearings, apparently. Fannie, by itself, sponsored 19 fundraisers for Oxley after this. 19. There's another representative, I think, from Wisconsin, Paul Ryan. He was holding town hall meetings about Fannie and Freddie in his district. Fannie called up all mortgage holders in his district, totally misstated his positions, and this guy got a lot of trouble. It created a big mess for him, of course. And keep in mind, all of this is being subsidized by the U.S. taxpayer. So Fannie is destroying his political enemies, and we are paying for them to do it. So Fannie and Freddie are sort of like a quasi-governmental, organization that has a lot of mysterious power and can do whatever it wants and have whatever it wants done. Subprime crisis. What's happened in the last year? Okay, banks are losing money on mortgages, things like this. So everyone in the government, this includes the Fed, the Treasury Department, the head of the Senate Committee, who's died, the head of the House Committee. Fannie and Freddie should buy more mortgages, and so Fannie and Freddie are basically used as a dumping ground for garbage. Now these are institutions that are in questionable financial shape. Nobody really knows what their books are like, even after their billion-dollar audits. And billions of dollars had to be restated. Somebody disappeared in income from. Now, at the same time, while this is all going on, there's a capital surplus requirement set by the regulator. Fannie and Freddie are getting less and less capital. It's disappearing. So as that happens, the regulator keeps lowering the capital resource requirement. With 30%, they lowered it to 20, then they lowered it to 15. And Freddie keeps putting out press releases or talking to the press and saying, we have this much more capital than the minimum set by our regulator. So everything is fine. And I've read dozens of articles that said that. Now, one reporter said, yes, but the regulator lowered the rating so they could have it. Not one, not one. And these people are writing articles, they don't even know this basic piece of information to tell the public. Well, they either don't or they're not telling us. And you should ask yourself why. Fannie's leverage, and we define leverage, someone asked this the last time, liabilities to shareholder equity is divided, and there's off-balance, on and off-balance sheet items, you have to add both of those together. The leverage comes out to 78 to 1. Now, Bear Stearns had 33 and imploded. Fannie is double, more than double that. I mean, this leverage is astronomical. Other important things, Fannie's mortgages, 21% are for over 80% of the original home value. Now, that's the original home value, not the current home value. If housing falls 20%, 30%, 50%, a huge percentage of Fannie and Freddie's mortgages will be over 80%. And there are different figures. About 20% of the loans are Alt-A or subprime. Now, not a lot are subprime. They're mostly Alt-A. But these loans are very risky, and almost all could fall apart. So, I mean, there's lots of risk here. The year-over-year foreclosures, it's 4.7 billion in Q1. That's twice of what it was last year. Next year could easily be twice as much again. And, this number is going to go way, way up. By Q1, this is the first quarter this year, Freddie's liabilities exceeded its assets by 5.2 billion. So based on accounting principles, this is an insolvent company. Now, I've said this here many times. We first questioned Freddie last fall. It's in the notes in the December meetup. You can go look. It's our Freddie and Fannie next, question mark. We had a list of the dirtiest dozen companies. Fannie and Freddie on that list of, most at risk to go under. We mentioned in the very last meeting, we said Fannie and Freddie are insolvent. I don't know what's keeping them together, and within days they fell apart. So anyone who was here last time heard that, or any of these other things. Now, of course, an expert governor says it, and then the world pays attention. Anyone could look at these figures. Anyone. In fact, I'm sure thousands of people looked at it and said, hey, these are insolvent. Nothing happened until some important person said this. So I think we are living in an era of the emperor's new clothes. The bailout. What happened? The Fed opens its discount window to Fannie and Freddie. This is a very significant event. For decades and decades and decades, only commercial banks could borrow from the Fed. In March, they allowed broker-dealers to borrow from them. Now, Fannie and Freddie can borrow from them. And I think this is a trend. You're going to see the Fed lending to more and more and more institutions. And probably by the end, Ralph's department store in Sheboygan, Wisconsin will be on the list. Now, to do this, the Fed is going to have to create a lot more money. This is all highly, highly inflationary. And I wouldn't be surprised if GM or Ford went up on this list. So, I mean, there's a trend. What's next? Who's next in this list of the Fed lending people? The Treasury was given a blank check. And that's blank check to lend money or buy Fannie and Freddie stock up to the end of 2009. This is unbelievably dangerous. I mean, it also shows there is no monetary control, fiscal control rather, in Washington. There's no monetary control either. And the Congress will agree to anything, any amount of money, and that's the key to an inflationary environment. There's no controls of spending. We'll spend anything. And both Republicans, Democrats, there's almost nobody left. Ron Paul and 3 other people. And also, 400,000 homeowners can get affordable mortgages backed by the FHA, which the FHA by itself is losing money. It never lost money in 70-something years of existence. The last quarter it started losing money. So this is making sure it's going to lose a lot of money. The taxpayers pay for all of this directly. This program is very bizarre. I read the details that people who could afford to get the new mortgages. Well, if they could afford it, they wouldn't need these mortgages. So, it sounds like on the surface nobody qualifies for this. But, I guess the details are different. And what they're basically rolling over bad mortgages to extend the time period and lower the payments. And that doesn't mean they won't fail. That means they will fail later on instead of right at this moment. Now, there was about $4 billion in neighborhood grants. This sounds like some pork barrel stuff to me, where favorite people can get lots of money. The cost estimate, and this is the most outrageous thing, was $25 billion for this bailout. This is the exact same cost for the Iraq War. When they go back and look, 20 to 30 billion was the estimate, so I'm averaging 25 billion. It is going to be at least $1 trillion, if not more, and I think you should assume the same for Fannie and Freddie. And even worse, they said there's a greater than 50% chance the bailout will cost nothing. Nothing. Now, Freddie is insolvent. It has to have money pumped into it. There's zero chance this bailout can cause nothing. So you should assume that the government totally lies about these things. This is just another lie. And if the press reported, oh, this is the same estimate for the Iraq War, so consider that one, people would not be so lackadaisical about this. Now, of course, even widely are saying, oh, this is not going to cost anything. In this next paragraph, we're raising the national debt ceiling $800 billion. Well, why do they need to do that if this is not going to cost anything? Or $25 billion, we could easily afford the $25 billion in the current national debt. So, this tells you the lie. Just a total and complete lie, total and complete lie. This is the 6th time the national debt ceiling has been raised during the Bush administration. We mentioned the last time was in October. It didn't even take a year for another $800 billion. And the debt ceiling is now 10.6 trillion. This is just on balance sheet items. The important thing is, if Fannie and Freddie are completely backed by the United States government, which they're claiming they're not doing, despite reality, is that this would go into the national debt also. And they have $5 trillion in debts. So the national debt would go from 10 trillion to 15 trillion overnight. And that's bigger than our GDP. And this is just there's a lot of off-balance sheet national debt. The real debt's really 50 or 60 trillion. There was an audit in May that said Fannie and Freddie had $20 billion in undeclared losses. Now, and those are not shown up. Some of them showed up maybe on the books in the August reports. So there's a lot of money that is known that they've lost that they've not reported yet. Not to mention a lot that it's not known that they've lost. But that's a separate issue. There are new accounting rules which are likely to mean Fannie and Freddie need to raise $75 billion more in capital. Who's going to give them this money? Especially, oh, I'm an insolvent institution. Could you please, give me $75 billion? I suspect the United States government is going to be giving this money. Another great risk is mortgage insurers go under. These companies are all moribund and on the risk of disappearing also. These are not bond insurers, they're mortgage insurers. A lot of them go into almost nothing. If that happened, Fannie and Freddie would have $1 trillion of exposure. If you go back and look at what happened in the 1980s, if you have an inflationary period with high interest rates, Fannie and Freddie can start losing money and continually lose money. And why is that? Because they have sort of income from long-term investments, but they have to borrow short-term. So if the short-term rates become higher, they constantly lose money every time they borrow. So we could get into that. And this happened in the early 80s. They were losing, Fannie was losing $1 million a day. It wasn't that bad. This could happen again, except for we have a lot of inflation. They could wind up losing millions of dollars a day, or tens of millions even. And of course, the U.S. taxpayer will have to pay for all of this. So another risk, a recession and continued drop in housing prices. What's going to make the market recover, housing market recover, I have no idea. So we should assume housing prices are going to continue to drop. As far as we're concerned in this meetup, we are in a recession and have been in one since the end of last year. And in case you missed it, they revised the GDP reading. There's a huge amount of derivative exposure in Fannie and Freddie, and when they had the audits in the early 2000s, they discovered that derivatives were not accounted for accurately or well at all. And so this is a huge time bomb sitting in both of them that could blow up. Last, the U.S. government AAA credit rating could be endangered. S&P earlier this year said that Fannie and Freddie went under and the U.S. government had to back them, that they might have to lower the AAA rating of the U.S. government. And Moody's made some similar statement a couple of months ago. So that's how risky and dangerous this is. And you're not hearing this, the press is not telling you this, you know, everything is being swept under the rug.
What would be the consequence if the government's AAA rating was downgraded?
It would be disastrous. I mean, higher interest rates, much higher interest rates. And anything that it backs, it would have to have much higher interest rates. And it would damage the dollar. And it doesn't make any sense to me because the U.S. government can print all the money it wants. So if you borrow $1,000 from them, they can give you $1,000 back no matter what happens. Now that $1,000 may not be worth very much, but they can pay that bond back. You know, a company doesn't have it. Only a government has this ability. So they should all have AAA ratings, although it's rather meaningless. NYMAC is a very big savings and loan. And it failed right after the last meeting also. And this is a very significant failure. There was actually a run on the bank and they had to call in the police. I'm not kidding. This is like what happened in the 1930s in the United States during the Depression. And it's happening right now. And everyone's saying, oh, everything's fine. You know, when do you remember this happening? So this is the second largest bailout in U.S. history from the FDIC. It's the largest savings and loan bailout, second largest in total. It was not on the FDIC keeps a list of troubled banks. It was not on that list. Now, after the fact, it wound up on that list, and this is really disturbing. And I read it's not on the list, and I actually sent email to Alexander, I don't know if you can see him, and said, the guy who does the videos, and I said, just wait, it's going to wind up, it was really on the list all along. And a week later or so, news came, oh, it was really on the list all along, it was only came in the last month, and it's it, blah, blah, blah. And I said, so predictable, it was not on the list. Now, the FDIC is responsible for what goes on in the banking system and knowing if there's any problems. Now, this is the second largest bailout in U.S. history, and they didn't know there was a problem. How accurate are their other estimates of the banking system? How many other problems are out there that they don't know about? The first thing the FDIC did when it took over NYMAC, it stopped housing foreclosures. This is possibly a little-known fact. And the government is determined to, just won't foreclose on all these bad loans. And I've actually heard, I've heard personally and read in a number of places that banks are not foreclosing on bad loans. They just wait, they stopped it, they don't want them on their books. There's $53 billion in the FDIC insurance company, and this is like if a bank goes under, you're insured for up to $100,000. NYMAC will lose up around 10% of that. The estimates are $4 to $8 billion. 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 $4 Now, if there was a large bank failure like, say, Washington Mutual or Wachovia, one of those banks alone would wipe out the entire FDIC fund. One. And it is inevitable this fund is going to have to be bailed out. The problem is most of these institutions, the government cannot let them go under. So it has to bail them out, it has to give them money. Because the consequences would crash the whole financial system. And if the FDIC went under, people would not trust the banking system. They would take all the money out of the banks and hide it in their mattress. Throughout history, there's been many runs on banks. And, they were very common before the 30s. Before FDIC insurance came out. And then not every bank failed because it was a run on the bank. If the bank was actually solid financially, it would not fail. The easiest way you can check whether a bank is solvent is to look at its stock chart. If the stock has gone down like 90-something% in the last year, people know that's a very strong message that bank's in really bad shape.